a huge pleasure to be here. I want to thank Raha, Zachary, and all our friends and colleagues at AIM Summit for bringing us together. And it is a particularly interesting time, as you heard in the beginning. And I would argue it's a particularly interesting time for alternatives. We are exiting a period in which both the supply and demand for alternatives had a huge tailwind. Demand was being pushed into alternatives by repressed yields, by elevated valuations, by massive liquidity, and by regulators who were looking at the asset classes in alternatives and not quite understanding what they were looking at. And it was also a great time for supply. And we've seen a massive proliferation of alternatives. This is going to be a different period coming up. It's going to be a period where there's going to be a lot more questions being raised, and I'm going to explain why that's the case. It's because of the neighborhood. I want you to think of a simple image that I'm going to use over and over again. You think you know your starting point. You think you know where you want to end up, but you have no idea about the journey that's going to take you there. Before the Ukraine war, that applied to longer-term issues, climate change. We knew where we wanted to get to. We didn't quite know how we're going to deal with the transition issues. It had to do with battling future pandemics. How do you vaccinate the world? It had to do with supply chains resilience. It had to do with inequality. We knew our starting points weren't favorable. We knew we wanted to get somewhere better. We just didn't quite know how we're going to do that. And then along comes the Ukraine war. And the Ukraine war did two things. It moved the starting point backwards. And it's made the journey even more uncertain. Now, there's two ways of thinking about this. If you're a pessimist, and Nouriel will fit that category, it paralyzes you completely in terms of even going forward. If you're super optimist, you think, don't worry, it's going to solve itself. After all, it has in the past. I want to be somewhere in the middle. And I want to talk a little bit about what has been unleashed now that complicates the longer-term issues. First and foremost, it's the change in the baseline. A year ago, consensus was the following: high growth, transitory inflation. Now, if in the asset markets, that is a wonderful message to hear. You get supported by fundamentals, and inflation is transitory, so there will be no shock to the liquidity regime. Towards the end of the year, the baseline changed. High growth, but persistently high inflation. Again, fundamentals were fine. Liquidity regimes start worrying about it. Now, stagflation has become the baseline. Lower growth and persistently high inflation. That is a fundamentally different baseline for the global economy and for financial markets. Stagflation used to be the risk scenario. Now recession is the risk scenario. So the first thing that the Ukraine war has helped to do is completely change the distribution of potential outcomes for the global economy, and therefore the implications for both public markets and private markets. Part of that, of course, is this changing roles of central banks. In a high-growth, low-inflation world, in a high-growth, transitory inflation world, central banks are your BFF, your best friends forever. They will supply you with liquidity, and they will have the confidence to come in and curtail any volatility. In a high-inflation world, that role can no longer be played by central banks. So there's a fundamental change going on in how central banks react with the financial markets. There's also fundamental social change going on, inequality. In this country, it's about the cost of living crisis, which hits the most vulnerable segments of the population particularly hard. In parts of Africa, it's about famine. Social considerations are going to become much more important in how policy making is done going forward. Debt issues are going to become more important, especially in the emerging world. I have this image of little fires everywhere. If you're a commodity importing country right now, higher food prices, higher energy prices, slower global growth, stronger dollar. That's not a great world to service your debt in. And then we've weaponized the payment system. The sanctions on the Russian central bank that brought the 11th largest economy in the world to its knees was something that the national security apparatus hadn't thought about. They didn't realize that in economics and finance, that was basically a nuclear weapon. But now that we have weaponized sanction on international payments in such a big way, there's a real question as to what does that mean for the system as a whole? These three things, all these things speak directly to the three things that people that are in the room that invest with you care about: expected returns, volatility, and correlations. And they play havoc with all three. Why do they play havoc with all three? Because in a world left to its own devices, these elements become more unstable. It is what economists call multiple equilibria. You move further away from a starting point, but rather than revert to the mean, the dynamics will take you even further away. So that means that the short-term problems become more acute, the longer-term problems become more acute, and we find it all very difficult to predict 4 risk factors in particular: interest rate risk, liquidity risk, credit risk, and market functioning / regulatory risk. So that's the world in which we're all functioning in. That's the world that public markets haven't been able to deal with well. You heard about the record sell-off in the safe havens at a time when you get a 20% plus loss on your risk assets in the public markets. And it's a world that alternatives are not going to be immune from. It's a world in which alternatives are going to have to think smarter in order to navigate. So how do you navigate that world? A lot of that, I suspect, is going to be covered in the panel with Danny. You will be taking a view on the neighborhood effects. Whether you're investing in private equity, in bitcoins, you have a view on the neighborhood effects. And you have to make 4 distinct judgments on the neighborhood effects. So if you think in terms of what economists call reduced form equations, you're facing incredible complexity. You don't want to be paralyzed. So you want to come up with a handful of factors that can explain 70 to 80% of outcomes. Not 100%, but 70 to 80%. What would that be? On the neighborhood effects, you're going to be taking a view on leadership. Leadership at the national level, leadership at the firm level. You're going to be taking a view on cognitive diversity. The people you're betting on, are they cognitively diverse enough to think in terms of different frameworks? Are they willing to revisit their priors because the world around them is changing so quickly? And are they able to keep an open mind? You're going to be taking a view on inflation. Not just will inflation come down, but come down to what level? How much breakage in the process? How much institutional credibility is lost? And how big a policy mistake do we get? We will get a policy mistake because central banks are so late. The question is, how big is it? And finally, you're going to be taking a view on not just the war in Ukraine, but what has the war done to the global order? Taking those four views is going to allow you to answer the following question, and that's where I'm going to conclude now that Nouriel just came in. How long does the process of restoring value to public markets take? That's going to be key for alternatives. Are we done on the bond side? Are we done on the equity side? Because at some point, value will be restored to the public markets. And the massive tailwind that alternatives had will be less powerful. The portfolio construction that you wanted coming into this world was very barbelled. You wanted to be in very short-dated, safe assets, and you wanted to be in alternatives. And you basically wanted to void the public markets. As value gets restored, what you'll get is a migration from that barbelled into something much more even. And finally, what are the implications for not what you invest the money in, but how do you organize your firms? How do you communicate with your clients? Successful firms are going to have three characteristics. First, resilience. You will make mistakes in the world we're living in right now. The world has become that uncertain. The question for you is, are they recoverable mistakes? Most mistakes are recoverable in the investment world. But you need a frank discussion about what are recoverable mistakes and what are unrecoverable mistakes. And how do our customers and clients view that? So resilience is going to be very important. Optionality is going to be critical. You want to maintain as much optionality as possible until things become clear. So how quickly do you give up liquidity? At what price do you give up liquidity? What confidence you have on your private credit are going to be absolutely critical. And the final issue that's going to differentiate the successful firms from the others is agility. Because if you see the world that I see, it is a world that has a lot of risks, but there are also going to be massive opportunity as we basically reset things at the firm level, the national level, and the global level. And with that, I'm going to stop and then hand over to Danny to come up and host and moderate our panel. Hold on. Oh.